Welcome to the Deep Dive. Today we're diving into something that honestly trips up so many investors. It's this paradox, right? We have all this information, data, endless analysis, but somehow we humans still manage to consistently buy high and sell low. It costs billions. So if you feel like you're just drowning in market headlines, maybe feeling a bit overwhelmed, and you need a clearer way to think, well, this deep dive is definitely for you. Our mission today is to unpack why this happens. We're not just looking at what market cycles are, but the psychology behind our reactions to them. We'll draw on insights from people like Howard Marks, look at technical patterns, and even touch on tools like the TAPE ratio to help you sidestep those costly emotional traps.
Yeah, and having that kind of framework is, it's really essential. We've looked at sources that bridge that gap between how markets are structured, the cycles, the indicators, and our own behavior as investors. And what's really striking when you pull it all together is the data. You look at analyses like DALBAR's, and they keep showing the same thing over and over. It's not the fees usually, or picking the wrong fund that hurts performance most. It's us. It's the timing errors we make because of emotion. Our goal here is to give you the context to, well, stop being the biggest risk in your own portfolio.
Okay, right. So let's get into it. Starting with the basic rhythm of the market itself. Our sources talk about two main types of market movements, secular and cyclical. You break that down. It sounds like big waves versus small waves.
That's a great analogy, actually. And understanding the difference is, well, it's vital. It sets the stage for realistic expectations, maybe over the next, 10, 15, 20 years. Secular markets are those huge long-term trends. Think 15, maybe 20 years. They're driven by really big fundamental shifts, maybe massive tech changes, demographics, new energy sources, that kind of thing. Like the big secular bull run we saw after 2013, a lot of that was fueled by things like AI becoming mainstream, big data, the shift towards cleaner energy. Really transformative stuff.
Got it. So those were the massive tides.
Exactly. And the cyclical markets, they're the waves riding on top of those tides. Much shorter term, could be months, maybe a few quarters. Often they affect only certain parts of the market. But here's why the secular context is so critical. It really sets the market's overall mood.
The mood. Tell me more about that. What does that actually mean for an investor?
Well, we often talk about multiple expansion or multiple contraction. In a big, long-term secular bull market, you tend to get multiple expansion. And that's not just jargon. It means people, investors, they believe the future looks so good they're actually willing to pay more for each dollar of a company's current earnings. You're essentially paying a premium based on future hopes.
Okay, so in simple terms, during those good times, a stock might trade at, say, 25 times its earnings, even if the company's profits aren't actually skyrocketing.
You got it. That's multiple expansion. And the flip side happens in secular bear markets. You get multiple contraction. Investors get nervous, maybe pessimistic, or just plain indifferent. They're not willing to pay that premium anymore. So the multiple might drop way down, maybe to 12 or 15 times earnings. And that means even if a company is doing okay fundamentally, the overall market returns can be pretty weak because nobody wants to pay up. Knowing that context helps you decide how much risk feels right.
Okay, that makes sense. That long-term view sets the scene. But like Howard Marks emphasizes, what happens on that scene, the actual ups and downs, that's driven so much by human emotion, isn't it? These cycles aren't just mechanical charts. They're like psychology visualized. If optimism is a key driver, how do we spot it becoming excessive?
Yeah, Marx has some really sharp insights here. He says you need to look at the extremes, the peaks and troughs. And those extremes are usually fueled by three main behavioral forces getting out of whack. When the market gets way too high, it's rarely just about rosy economic forecasts. It's about the emotional state of everyone involved. The first driver, just runaway optimism turning into euphoria and then pure greed. Marx pointed to the 90s tech boom, Maybe the actual value of companies was growing, say, 6 to 10% a year, but the S&P 500 was climbing 20% a year. That huge gap, that's the emotion being priced in. And at that peak, the fear of missing out FOMO just totally swamps any rational fear of losing money. Everyone feels like they have to buy right now.
Right, FOMO. We've all felt that pressure, so everyone piles in at the top. What happens next? How does that optimism curdle?
Well, that's when the second driver kicks in. Risk aversion just vanishes. People stop being cautious, demanding a margin of safety, doing careful research, all that sensible stuff kind of goes out the window. The conversation shifts from, is this safe, to how quickly can I get rich? How the dominant thought becomes, look, the more risk I take, the more money I make. Which sounds great until it doesn't. That's not confidence, that's pure recklessness setting in.
But hang on, couldn't you argue that when things are booming, maybe less caution is justified? How do we know it's crossed the line into recklessness?
That's a fair question. I think the difference is confidence is based on facts, on analysis. Recklessness, that's based on the assumption that things can only go up, that nothing can possibly go wrong. When people stop asking what if and start thinking this will go on forever, that's a huge red flag. That's usually when you're nearing a peak. And the third part of this extreme mix is abundant capital. Just too much money sloshing around, chasing too few genuinely good opportunities. It creates bidding wars for assets, pushing prices far beyond any reasonable intrinsic value. And of course, if you buy then, you're pretty much guaranteeing yourself lower future returns.
Okay, so it's this spiral. Optimism fuels risk-taking, which leads to inflated prices fueled by too much cash. Well, let's connect that to the charts. How does this emotional roller coaster map onto those 4 technical stages of a market cycle that Schwab talks about?
Right. The technical picture often reflects this psychology pretty clearly. It usually starts quietly with stage 1, accumulation. This is the, frankly, boring phase. Prices are moving sideways, not doing much. Most retail investors aren't interested because the news isn't exciting, but this is where the smart, patient money, often institutions, are quietly buying shares, trying not to push the price up too quickly.
Okay, so the quiet buying happens first, then things start to heat up.
Exactly. That brings us to stage 2, markup. This is where the price breaks out, pushes convincingly above those old resistance levels. You see that classic breakout on the chart. Volume picks up, more buyers jump in, attracted by the momentum. You start seeing that pattern of higher highs and higher lows. This is where things can get really exciting, even euphoric, as that greed factor we talked about takes over. Prices can go up very fast.
But the institutions that bought early, they need to sell eventually, right? Which leads to that tricky topping phase.
Precisely. Stage 3, distribution. This is a really critical stage to recognize. The key sign is often increasing trading volume, but the price stops going up. It churns. What's happening? The early buyers, the institutions, are now quietly selling their shares. And who are they selling to? Often it's the retail investors who finally jumped in, driven by that FOMO from the markup stage. Initially, this new demand absorbs the selling, but eventually there's just too much supply and the price starts to falter. A key technical signal here is when the price breaks below its 200-day moving average. That often confirms the top is in.
And from distribution, it goes downhill fast. Stage 4, markdown or decline.
Yep, that's the cascade. All those people who bought during the distribution stage are now losing money. Fear kicks in, they start selling to cut their losses, leading to more selling. Since the big institutional buyers already got out, there's often very little support. Prices can fall sharply until the selling pressure finally exhausts itself, usually at some key lower support level, and then the cycle eventually begins again.
It's a clear pattern, driven by that predictable psychology. So, if emotions are the engine, investors obviously need tools to gauge when things are getting out of hand. Let's talk about a couple of those indicators mentioned in our sources. The SEPI-E ratio comes up a lot for valuation checks.
Right, the SEPI-P ratio, cyclically adjusted PE ratio, sometimes called the Shiller PE, it's a really powerful tool because it tries to filter out that short-term market noise. Instead of just looking at last year's earnings, it divides the current stock price by the average real earnings per share over the last 10 years, adjusted for inflation.
And why 10 years? What's the magic in that number?
It's designed to smooth things out. Corporate earnings can bounce around a lot year to year, right? If you just use a standard PE ratio, well, during a recession, earnings might plummet, making the market look super expensive right when it might actually be a bargain. Conversely, during a boom, earnings look amazing, making stocks seem cheaper than they really are, valuation-wise. Averaging over 10 years captures a full economic cycle, maybe more. It gives you a better sense of the underlying long-term valuation, stripped of those temporary peaks and valleys. Generally, a high CAPE suggests caution is warranted. A low CAPE suggests potentially better long-term returns ahead.
Okay, that makes sense, smoothing out the noise. Now, there's another indicator mentioned, one with a pretty dramatic name, the Hindenburg omen. Sounds serious. What's that flagging?
Yeah, the name definitely grabs your attention. It's a technical indicator designed to spot internal weakness or divergence within the market. Think of it like the engines are sputtering even if the plane looks fine from the outside. Specifically, the omen gets triggered when you see a strange split on the New York Stock Exchange. A significant number of stocks hitting new 52-week highs at the same time as a significant number are hitting new 52-week lows.
Wait, how is that even possible? Highs and lows at the same time?
It seems counterintuitive, right? But it suggests the market rally is really narrow. Maybe just a few giant mega-cap stocks are pushing the index higher, while underneath the surface, most other stocks are actually struggling or falling. It signals fragility, a lack of broad participation in the rally.
Okay, so it's a warning sign of internal weakness.
Yeah.
But how reliable is it? If it triggers, should you sell everything?
Whoa, definitely not panic sell. Its predictive power isn't perfect. The data suggests a single trigger might only precede a significant market decline, maybe 20–25% of the time. Its real value isn't as a precise timing tool, but more as a warning flag, like you said. It suggests underlying risk is increasing. Often, if a significant decline does follow, it happens maybe 3 weeks to 6 months after the omen first appears. So it's more like a check your risk level signal, not an eject now button.
Got it. So bringing this all back to the listener, what's the bottom line impact of letting emotions drive decisions? We mentioned the DALBAR data earlier. Let's really look at that cost.
Yeah, the numbers are pretty sobering because it shows how much performance we leave on the table ourselves. In one specific year cited, the S&P 500 index returned a fantastic 25.02%. Great year. But the average person invested in equity funds, they only earned 16.54%. That gap, almost 8.5%, wasn't primarily due to fees or fund manager skill. It was overwhelmingly because people timed their buys and sells poorly, likely buying late in the markup phase and selling during the markdown panic.
And we see this again and again in crises, don't we? It's almost like clockwork.
It really is predictable. Think back to the 2008 financial crisis. So many people panicked and sold everything near the bottom, locking in huge losses. And then they missed the incredible recovery that followed over the next decade. Or even more recently, that sharp COVID dip in March 2020. Huge panic selling. But the market bottomed incredibly quickly and staged one of its fastest recoveries ever, getting back to new highs by August 2020. Selling in March was devastating.
And the culprits are those familiar behavioral biases, right? Herd mentality, everyone else is selling, I should too. Loss aversion, that pain of losing feels way worse than the pleasure of gaining. And recency bias, assuming this downturn will last forever.
Absolutely. Those are the big ones. And if you look across all the expert advice, the consensus is really clear. Being a successful long-term investor isn't about having a crystal ball to predict the future. It's almost entirely about managing your own behavior, your own emotions, right here in the present moment.
Okay, so let's shift gears completely then. Let's get practical. For someone listening right now wanting to avoid those traps, what are the key actionable steps they can take to stay disciplined when the market inevitably gets volatile?
Okay, 5 key things come up consistently. First, and maybe most important, anchor yourself to a written, goals-based financial plan. When things get crazy, when the headlines are screaming sell, this plan is your rational anchor. It pulls your focus away from the short-term noise and back to your long-term goals. Why are you investing in the first place? Your plan reminds you. Second, rebalance your portfolio with discipline. This means periodically selling some of the investments that have done really well and buying more of those that have lagged behind. It feels counterintuitive, but it's a structured way to force yourself to sell high and buy low, counteracting that emotional urge to chase winners.
Right. It systematically makes you do the opposite of what your gut might be telling you during euphoria or panic.
Exactly. Third, focus on what you can actually control. You can't control inflation or what the Fed does or global events. Fretting about those is wasted energy. But you can control how much you save, how diversified your investments are, where you locate assets for tax efficiency, keeping your investment costs low. Pour your energy into those things. That creates real stability.
Fourth seems to be about managing information overload.
Yes, tune out the noise. Seriously. The financial media often thrives on drama, urgency, and fear because, well, that gets clicks and viewers. Reacting emotionally to every news alert or market swing isn't an investment strategy. It's a recipe for mistakes. Learn to distinguish the real signal, the big important shifts from the constant everyday noise. And finally, number 5, use context. Don't rely on just one indicator. A scary CAPE ratio doesn't automatically mean crash tomorrow. A Hindenburg omen doesn't mean sell everything. You need to combine different indicators, valuation, technicals, investor sentiment, and check them against the fundamental backdrop, like what's happening with corporate earnings and the broader economy. Look at the whole picture.
That's a really solid set of actions. It frames resilience as the goal, not prediction. Market cycles will happen. They're part of the deal. The key is building a strategy and mindset robust enough to handle them. It sounds like the biggest risk really is ourselves.
It often is. And maybe to wrap up, if we zoom out to the absolute biggest picture, remember those secular waves we talked about? There's an even longer concept, Kondratieff waves or K waves. These are massive 50 to 60-year cycles driven by truly fundamental technological innovations that reshape entire economies and societies, leading to the rise and fall of dominant industries.
Wow, 50 to 60 years. That really puts long-term investing into perspective.
It absolutely does. It's the ultimate context. Some analyses suggest the current K-wave, K-19, driven largely by information technology and centered around Silicon Valley, might be nearing its end phase. And they predict the next wave, maybe K-20, could start around 2030. This would represent another profound reshaping of the global economy. What might drive K-20? Predictions focus on things like fully integrating this wired world we've built, and maybe, crucially, a massive shift in global energy systems towards cleaner, more sustainable structures. So, the final thought to leave you with is this. How might the disciplined choices you make today, sticking to your plan, not panic selling, managing your behavior position to not just to get through the next inevitable market dip, but to potentially benefit from the enormous structural changes and opportunities that might come with the next 50-year K-wave? That's the ultimate payoff for emotional discipline.
That is a huge thought to ponder, thinking not just cycles, but super cycles. Thank you for guiding us through this today, giving us that framework for resilience. We really encourage you to dig into the original sources yourself. Join us next time for another deep dive.